OG Macro AG here. Let's slow this down. Let's strip the emotion out of it. And let's look at what actually happened in the metals market. Because what we just witnessed was not normal volatility. It was structural stress surfacing in real time. We saw JPMorgan close 633 short contracts in silver at what, by any objective measure, marked the exact local bottom of the move. Not hours later, not days later, not after confirmation, at the bottom. That timing matters, not because it proves intent, but because it reveals information asymmetry, liquidity pressure, and who is forced to act when volatility spikes. Today's video is not about outrage, it's not about conspiracies, and it's not about predictions. It's about market mechanics under stress, and what they tend to reveal when leverage unwinds faster than liquidity can absorb it. Let's start with the tape. Silver sold off violently, down roughly 8 to 10% peak to trough, depending on the contract and time window you're looking at. Gold followed, but with noticeably less velocity, down closer to 3 to 4% at the lows. That divergence is the first clue. This wasn't a fundamental repricing of precious metals as a whole. It was a liquidity event, concentrated in the most leveraged, thinnest, and most paper-heavy segment of the complex: silver. When you see silver fall 2 to 3 times faster than gold, you are not looking at a demand collapse. You are looking at forced selling. And forced selling has rules. It doesn't care about fundamentals, it doesn't care about valuation, and it certainly doesn't care about long-term supply constraints. Forced selling sells what it can, not what it wants to. Now let's address the data that sparked the conversation. JPMorgan closed 633 silver short positions right at the lows. That's not an opinion. That's a reported positioning change. Does that automatically mean the move was planned? No. But here's what it does mean. Large institutions do not cover size at random prices. They cover when liquidity appears, when volatility peaks, and when risk managers allow it. In other words, they cover when others are forced to sell. That's not manipulation, that's structure. And retail traders consistently misunderstand this. Big players don't need to predict bottoms. They create the conditions where covering becomes possible. When volatility spikes, margin calls cascade. When margin calls cascade, selling becomes price insensitive. When selling becomes price insensitive, liquidity briefly appears. That's where shorts get closed. Immediately after that low, silver bounced. Not because sentiment improved, not because macro risk disappeared, and not because fundamentals changed overnight. It bounced because selling pressure exhausted itself, temporarily. In leveraged markets, bounces often happen for mechanical reasons, not informational ones. Here's the sequence. Volatility rises, margins increase, weak hands liquidate, price overshoots, liquidity briefly returns, shorts cover, price rebounds. That rebound is not a signal, it's a release valve. And if you confuse release valves with trend changes, you misread risk. Let's talk levels, but carefully. Silver broke below prior support zones that had held for months. Once those levels failed, stop-loss clustering accelerated the move. This is important. Stops are not opinions. Stops are orders waiting to become market sells. When enough of them stack up near the same price, breaking that level doesn't just move price, it changes market state. On the downside, the market searched for areas of prior high volume, zones where options gamma flips, levels where dealers reduce short exposure. That's where the bounce came from. But technically speaking, reclaiming a level once does not restore structure. Structure is restored only when volatility compresses. Volume stabilizes, time is spent above reclaimed levels. None of that has happened yet. Now, zoom out. This move did not start in silver. It started in liquidity. Across markets, we are seeing rising funding stress, higher collateral demands, tighter balance sheets, reduced dealer intermediation. When liquidity tightens, leverage becomes unstable. Silver is one of the most leveraged commodities on Earth. High paper volume, low physical float, thin dealer depth. That makes it fragile under stress. When risk-off events hit, whether from rates, equities, or credit, silver becomes a liquid funding source. Not because it's weak, because it's tradable. Here's where it gets interesting. While paper prices were collapsing, physical signals did not confirm the move. Premiums in Asia did not collapse. Retail physical demand did not vanish. Delivery delays did not suddenly resolve. That doesn't mean price can't fall further, but it does mean price is being driven by paper flows, not physical repricing. Paper markets can move faster than physical markets, until they can't. And when that gap widens, volatility increases, not decreases. This is not about calling a bottom, it's about recognizing market condition. We are in an environment where liquidity is episodic, volatility is clustered, leverage is fragile, information is uneven. In those environments, extreme prints happen, and extreme prints often reveal who is forced and who is patient. JPMorgan's short covering is not proof of anything sinister. It's proof that stress creates opportunity for those with balance sheet capacity. That's how markets work. Let's pause here. So far, we've established the sell-off was liquidity-driven. Silver moved faster than gold due to leverage. JPMorgan covered into forced selling. The bounce was mechanical, not fundamental. Paper and physical markets are beginning to diverge. In part 2, we'll go deeper into Asian premiums and vault data, COMEX and LBMA inventory pressure, gold-silver ratios and mining ratios, spillover from equities and crypto, the broader macro backdrop, debt, rates, and policy uncertainty. No predictions, no hype, just probabilities and structure. Stay sharp, watch the data, think independently. OG macro AG out. Now that we've established what moved and why it moved mechanically, we need to look at what did not move. Because in stressed markets, non-confirmation matters as much as confirmation. This is where physical data, inventories, and ratios come in, not as predictions, not as timing tools, but as pressure gauges. When paper metals break sharply, the first place I look is Asia, not headlines, not Western ETF flows, but physical premiums. Shanghai is critical here. During the sell-off, Shanghai silver premiums did not collapse in proportion to COMEX prices. In some windows, they actually firmed. That tells us something very specific. If this were a true demand shock, if end users were stepping away, you would expect premium compression, inventory buildup, softer delivery demand. Instead, what we saw was price weakness without premium collapse. That is a classic sign of paper-led dislocation. Now let's be clear. This does not mean price must immediately rebound. Physical markets can absorb price declines for a time, but it does mean the marginal seller was financial, not industrial. That distinction matters when volatility persists. Paper markets operate on milliseconds. Physical markets operate on weeks and months. When liquidity shocks hit, paper prices overshoot first. The physical market responds later, sometimes by reducing supply, sometimes by increasing premiums, sometimes by delaying delivery. Right now, we are in the lag window. Paper has repriced violently. Physical has not yet fully responded. That creates tension. And tension doesn't resolve quietly. Let's talk COMEX. Headline inventory numbers appear stable at first glance, but stability can be misleading. Here's why. COMEX inventories are eligible plus registered. Only registered is actually deliverable without conversion. Over the past several months, registered silver has been trending lower even when total inventory looks flat. That's important. It means more metal is sitting in the system that is not immediately available for delivery unless owners choose to convert it. In calm markets, that's fine. In stressed markets, that optionality becomes a risk variable. Paper volume continues to trade multiples of registered inventory. That leverage ratio is what makes silver volatile, not price levels themselves. London doesn't flash red the way COMEX does. LBMA data moves slowly, updates with delay, and rarely panics in real time. But what we do know is this. London vault stocks have declined materially over the past few years. Rehypothecation remains high. Physical bars move east when price allows. London acts as the buffer between paper trading and global physical flow. When that buffer thins, volatility increases, even if it's not immediately visible. Right now, that buffer is thinner than it appears. Forget absolute inventory numbers for a moment. Focus on ratios, specifically open interest to registered inventory, daily trading volume to physical float paper claims per deliverable ounce. These ratios are elevated, not unprecedented, but elevated enough that liquidity matters more than fundamentals. When ratios are stretched, small changes in positioning can produce outsized price moves. That's exactly what we just witnessed. Now let's talk about the gold-silver ratio. The ratio spiked aggressively during the sell-off. This is not new behavior. During stress events, the ratio tends to rise because gold is held as a reserve asset. Silver is treated as an industrial financial hybrid. Leverage concentrates in silver. A rising ratio does not mean silver is bad. It means risk is being repriced. Historically, extreme ratio spikes occur near periods of maximum uncertainty, not clarity. But again, this is not a timing signal. Ratios can stay extreme longer than traders expect. They tell you where stress is, not when it resolves. Now zoom out further. Silver mining ratios versus gold production remain structurally constrained. Most silver is mined as a byproduct, not as a primary metal. That means supply does not respond quickly to price signals, up or down. In other words, price volatility is financial supply, rigidity is physical. That mismatch is why silver behaves the way it does. Short-term, chaos. Long-term, constraint. Markets oscillate between those two forces. Right now, we are firmly in the financial dominance phase. This move did not happen in isolation. Equities experienced elevated volatility. Crypto saw sharp liquidations and funding stress. This matters because cross-market margin calls are real. When losses occur elsewhere, leveraged players raise cash where liquidity exists. Silver is liquid. Silver trades around the clock. Silver has deep derivatives markets. That makes it a source of liquidity, not a destination, during stress. This is not bearish or bullish. It's mechanical. Now let's address the macro layer. We are operating in an environment of elevated global debt, tightening financial conditions, unclear central bank reaction functions, rising geopolitical risk. The Federal Reserve's messaging remains uncertain. Markets are attempting to price slower growth, sticky inflation, potential policy error. That combination increases volatility across asset classes. Precious metals are not immune to volatility, especially when leverage is involved, but they are also sensitive to liquidity, not just rates. When liquidity contracts suddenly, everything trades like risk, temporarily. Let's be clear about what this is not. This is not a confirmed bottom A, confirmed top proof of manipulation. A signal to act. It is a stress event revealing structural characteristics. Those characteristics matter more than any single data point. So where does that leave us? We now understand. Physical markets are not confirming paper weakness. Inventories remain tight relative to paper claims. Ratios reflect stress, not equilibrium. Macro uncertainty is elevated. In Part 3, we'll walk through the leverage unwind in more detail, margin mechanics and dealer behavior, two probabilistic scenarios, bearish continuation versus bullish stabilization, key levels and data points, not as signals but as risk markers, still no hype, still no promises, just structure, stay sharp, watch the data, think independently. OG macro, AG out. Leverage doesn't announce itself. It accumulates quietly through low volatility, stable ranges, predictable liquidity, cheap financing. Silver had all of that. For months, silver traded in relatively narrow bands. Volatility compressed. Option sellers got comfortable. Carry trades proliferated. That's when leverage grows. Not when markets are chaotic, but when they're calm. Then something shifts. Rates move, funding tightens, risk assets wobble, and suddenly, leverage that looked manageable becomes unstable. Here's the key point. Margin calls do not care about conviction. When volatility spikes, margin requirements increase. When margin requirements increase, collateral must be posted. If it isn't, positions are closed, automatically. This creates price-insensitive selling. And price-insensitive selling is what breaks markets, not bad fundamentals. In silver, where leverage is high and liquidity is episodic, margin calls cascade faster than in most assets. That's exactly what we saw. Another misunderstood piece: dealer behavior. Market makers provide liquidity conditionally. When volatility is low, spreads are tight. When volatility spikes, spreads widen. When volatility becomes unstable, liquidity disappears. This isn't fear, it's risk control. During the sell-off, dealers widened spreads and reduced size. That magnified the move, not because they wanted price lower, but because they couldn't absorb flow safely. Many people describe the move as feeling like an air pocket. That's accurate. Air pockets happen when stop orders, cluster, dealer bids, retreat. Liquidity thins, selling accelerates itself. Price moves not because new information arrives, but because existing orders get triggered. That's why bottoms in leverage-driven sell-offs often look dramatic and sudden, and that's why large shorts can cover into them. Let's bring JPMorgan back into this, but correctly. JPMorgan did not call the bottom. They responded to market conditions. At the moment of maximum stress, liquidity briefly appeared, volatility peaked, forced selling dominated. That's when covering makes sense. This is not omniscience, it's capacity. Large institutions have balance sheets that allow them to wait. Smaller participants do not. That asymmetry is structural, not conspiratorial. Now let's do what disciplined macro analysis actually does, not forecasts, scenarios. In the bearish case, global liquidity continues to tighten. Risk assets remain under pressure. Volatility stays elevated. Margin calls persist. Under this scenario, silver may retest or marginally break recent lows. Bounces remain shallow and volatile. Gold outperforms silver. The gold-silver ratio remains elevated. Importantly, this does not require collapsing physical demand. It only requires continued financial stress. This scenario remains plausible as long as funding conditions deteriorate. In the second scenario, volatility compresses, forced selling subsides, liquidity gradually returns, physical demand reasserts itself. In this case, silver stabilizes within a wide range. Price action becomes choppy rather than directional. Ratios stop worsening but don't immediately normalize. This is not a moonshot scenario. It's a repair scenario. Markets often need time, not catalysts, to heal after leverage events. Neither scenario assumes central bank rescue. Sudden monetary easing, immediate clarity. Those assumptions belong to narratives, not analysis. Right now, uncertainty is the dominant macro variable. Let's talk levels, but carefully. Levels matter because they affect behavior, not because they predict direction. Key things to watch. Whether silver can hold above volume-weighted support. Whether rebounds occur on declining volatility. Whether downside moves are met with increasing physical premiums. If volatility remains high, price levels lose meaning. If volatility compresses, structure begins to matter again. Not headlines, data. Specifically, margin requirement changes, open interest trends, registered versus eligible inventory shifts, Asian premium behavior, cross-asset volatility correlations. These tell you whether stress is easing or spreading. This is where many market participants struggle. They want resolution. Markets don't provide resolution on demand. They provide probabilities, and probabilities change. The correct response to uncertainty is not conviction, it's awareness. So now we've covered the mechanics of the sell-off, the role of leverage and margin, why large players act when they do, two plausible paths forward. In Part 4, we'll bring it all together. Macro risks and policy uncertainty. What matters next and what doesn't. A disciplined, non-emotional conclusion. No selling, no advice, just perspective. Stay sharp, watch the data, think independently. OG. Macro AG out. Let's finish this properly by zooming out one last time. Because if you only look at silver, or only look at JPMorgan, or only look at one violent candle on a chart, you miss the bigger picture. And the bigger picture right now is macro instability, not metal-specific weakness. We are not operating in a normal macro regime. Global debt levels are historically high. Sovereign balance sheets are stretched, fiscal policy is politically constrained, and monetary policy credibility is no longer absolute. Central banks are attempting to manage inflation that isn't fully under control, growth that is slowing unevenly, financial systems that depend on leverage. That combination produces policy uncertainty, not clarity, and uncertainty breeds volatility. Markets are overly focused on what the Fed might say next. That's noise. The real issue is that the Fed's reaction function is unclear. They are balancing inflation risks, financial stability, risks, political pressure, market dependence on liquidity. When reaction functions are unclear, markets price risk premiums, not narratives. That's what we're seeing now. There's a common misconception that gold and silver should always be calm in uncertain times. That's only true when uncertainty is directional. Right now, uncertainty is structural. Markets don't know whether tightening continues, whether something breaks, where liquidity ultimately comes from. In that environment, metals behave differently. Gold acts as a balance sheet hedge, but still trades liquidity. Silver behaves like a leveraged volatility instrument that doesn't invalidate their role. It explains their behavior. Now let's directly address the title question, without drama. Was this move planned? Markets don't need planning to produce extreme outcomes. They need high leverage, thin liquidity, asymmetric information. Those conditions existed. JPMorgan closing shorts at the lows doesn't prove orchestration. It proves structure. When markets are built this way, outcomes repeat. Not because of intent, but because of design. This is a crucial distinction. If you focus on motive, you get emotional. If you focus on structure, you get analytical. The structure of the silver market includes heavy paper leverage, concentrated liquidity windows, thin physical float, global funding dependence. That structure produces violent sell-offs, sudden reversals, asymmetric winners and losers. Understanding that doesn't make markets fair. It makes them understandable. Not opinions. Not social media narratives. What matters next is whether volatility compresses or expands, whether physical premiums stay firm, whether inventories quietly drain or rebuild, whether liquidity improves or tightens. These things evolve slowly, until they don't. That's why patience matters more than certainty. Also important, what not to focus on. Ignore single data points taken in isolation. Absolute certainty from anyone claims of guaranteed outcomes, emotional framing of market moves. Markets punish certainty more than ignorance. The goal is not to be right. The goal is to survive uncertainty. That means respecting, leverage liquidity time, and recognizing when markets are in stress regimes, not trend regimes. Right now, we are still in a stress regime. Let's summarize calmly. Silver experienced a liquidity-driven sell-off leverage, and margin calls amplified the move. JPMorgan covered shorts into forced selling. Physical markets did not fully confirm paper weakness. Ratios signal stress, not equilibrium. Macro uncertainty remains elevated. No conclusions beyond that are justified yet. Anything else is narrative. This market doesn't reward emotion. It rewards observation. So slow it down, watch the data, respect uncertainty. And remember, markets don't owe anyone resolution on a timeline.